Sushil Choksi, Director of Indus Equity Advisors, joins us on the show. Sushil, hi, afternoon. How are you approaching the market in the light of the weakness that we're seeing on the currency right now?
Thanks for having me on the show. I think currency is a factor which is indicating more dampness where the market conditions are. So we are in a make or a break situation that we need a political will and some measures to come out as the parliament shuts from the government and some action based on that from RBI too. And if rupee doesn't change its direction, I think we are in for a little shock going further. As the scenario from a global market perspective also, one doesn't know what the outcome of the EU summit is likely, because there are differences of opinion which are visible, as Germany is not willing to back the Eurobond. Maybe some outcome may be not fruitful as what other European nations are desiring. It can be a benefit out of these cracks, because if Euro cracks, commodities will crack along with it. But before that we'll have to see how other currencies behave, and rupee may be in tandem with what other Asian currencies have started behaving in the last few weeks.
Right. Sushil, given the way rupee is moved and it's no longer volatile, it's just one direction, do you think now IT becomes one of the most attractive sectors to look at?
Yeah, IT would be one of the most attractive sectors along with some of the pharma companies. But it's not necessary. You'll have to dissect each company, make sure that company is not overhedged in the situation where FX is concerned. But the global perspective also is putting a little pressure on the business sourcing from various zones. America is doing well, which is normally a 60% of the business side, and Europe is not in that good shape. Some of these other Asian nations are doing well. So one will have to watch out. Other than Germany and Europe, other countries are vulnerable. So a stock-specific scenario in the entire market would be a better zone. But the current scenario on rupee is clearly giving an indicative that MNCs, which are likely buyout candidates because of the current SEBI norm, would be the best plays in the market going forward, because we've seen two offers already made in this week from Saint-Gobain and AkzoNobel. Thomas Cook came up with a buyback offer. Maybe a few more offers are on the table in this next 30-35 days.
Right. Sushil, what is your sense on how much more pressure can the entire auto pack see? Because we've seen some dwindling sales volumes. There are concerns about currency fluctuation, as well as most of the revenue generation for most auto majors happens through exports. What is your take on the auto pack now?
I think exports may have a benefit because of the currency movement, but the sentiment globally may have a little dampener. So Maruti or maybe Mahindra & Mahindra will stand out. Hero Honda may stand out because they're looking at export market going forward. Bajaj Auto has already hedged their currency, so they may have a negative impact. And if you're putting the other way around, the global consolidation from Tata Motors balance sheet point of view, when you convert into rupees in the current market scenario, will be a benefit when you convert the numbers. But people are watching month-on-month numbers from Evoque and JLR. So my personal standout is, in the current scenario, if somebody is making a portfolio with 6 months to a 12-month or 18-month horizon, and specifically in a period of next 15 days when the markets are likely to be choppy because the events are too many, one or two positive triggers have come specifically about this Iran negotiation in last half an hour. So one needs to see how commodity behaves, and if commodity cracks, ultimately these auto majors will benefit, and oil being down along with euro would be helpful to India. But the rupee weakness has to stall first. As long as rupee continues to be weak, India is a sick nation right now in people's eye, and I think the direction needs to change for that. And if you compare it, just look at Brazilian real and the Bovespa and take a comparison of Indian rupee and the Nifty over a period of 1 year, you will be able to get some similarity.
Sushil, what about the banking pack? Would you look to invest in any of the banking stocks, and where would your bias lie, PSU stocks or the private ones?
I would stick to private ones right now, but during this quarter, specifically led by what SBI, Bank of India and Canara Bank has said, a possibility of bottoming out on the stocks, because the fear on the street about gross NPA and restructured book is too high. And possibly, looking at the current scenario, the majority of the balance CDR cases should be over in the first quarter. So nearing the first quarter results, it's possibly in June, once the news flow on the CDR is out, one will be able to make out what is the restructuring taking shape with. And based on that, you may take a call, because they may be attractive buy, but my bias is more with private banks right now, specifically led by ICICI.
Sushil, what is your take on the FMCG pack, and do you think in a volatile market environment like today's, there would be rush to safer haven pockets, the likes of FMCG?
Looking at the current scenario, I think it's like a safe haven bet. So following FMCG would be an ideal situation, because India consumption story, specifically in rural, with people getting empowered with Narega and other things, the freebies in the world which the local states are giving, is making the consumption story going right. So FMCG, I would say, specifically led by ITC, would stand out, and maybe other few names.
Sushil Choksi, thank you for joining us with that perspective.
And I have I personally feel many of the...
No, please complete your point.
Yeah, I was taking few names in pharma also, like Divi's Laboratory. FDC has announced a buyback. Some of the generic and domestic consumption story where pharma is concerned also would be an ideal candidate going forward.